Adapting to market volatility will be the topic for tonight, and it's very pertinent for this time of the year, I feel, and coincidentally we'll have some really good stuff to talk about as of late that's been going on in the market. So along with some of the theory, we'll be able to apply that and take a look at some charts, take a look at the recent market action, looking at the ES and the Euro, and kind of give us a path, if you will, going forward, especially into the summer as we head into this next weekend being Memorial Day weekend, and some of the changes that happen as we head into the summer months that, you know, is nice to prepare for and kind of curb our expectations, if you will, in the sense that the summer months tend to be a little bit different than the rest of the year for reasons that we'll get into. So if everyone can hear me all right, we'll go ahead and jump right into today's webinar. And as always, feel free to ask your questions and I'll get to as many as I can. So trading carries a high level of risk. You're subject to lose all or more of your original investment. Don't trade with money you can't afford to lose, or money that if lost would affect your current lifestyle. The information in this presentation is for educational purposes only and is not intended to be financial advice. The purpose of the webinar is to help you better understand the markets and improve your skills as a trader. I believe a balanced life leads to a healthy life, and our attitudes influence our behavior. Trading is a small but meaningful part of the bigger picture. I hope everyone had a great weekend. I spent my weekend up in northern Wisconsin, up in Rhinelander, and it was a very enjoyable weekend. We had a little bit of rain on Sunday, but nothing that would spoil the fun. So thanks for tuning in, everyone, tonight, and let's go ahead and jump right in. So a brief outline, we're going to be talking about the volatility index and how that relates to the markets, both on an intraday basis and on the broader term, broader scale. So we'll talk about what is it and what does it mean, how can we apply it to our trading. We'll take a look at the ES and the 6E and the ranges that we see, and how those change over time and how we can really adapt our methodology over time in different market conditions. Because as most of you probably know, it's great to have a methodology or a strategy or a system to follow, but it takes a level of adapting to certain changes that happen in the markets to remain consistent over time. And there's little tweaks and things that are important to pay attention to on the broader scale, on the broader terms of the bigger picture and what's going on in the market around us. So we'll take a look at a few indicators in that sense that can help us do that. We'll take a look at some ways to gauge the market speed when the market first opens in the New York session. We'll take a look at a few examples from that. And we'll talk about setting some expectations going into the summer and some things that you may want to look out for. And we'll wrap up with taking a look at the daily levels. We'll review, where we've been and where we've kind of transitioned to over the past couple of weeks. So we'll end there and we'll pull up some charts and we'll go through those. So getting right into the volatility index. Now, a lot of you are probably familiar with the VIX, and you may or may not apply it in your trading. But that is really one of the best instruments for gauging market volatility. So some of the basics behind the VIX and the volatility index, it's essentially an instrument comprised or built from the Chicago Board of Options Exchange, Chicago Board of Options Exchange Volatility Index, and it's constructed based on the market's expectation of 30-day volatility in the markets. And it's based upon the implied volatility of index options. So it takes the implied volatility related to puts and calls and comes up with a value that then acts as a gauge of fear in the sense. So the VIX is the most common, and that's based upon the S&P 500. But then there's also the VXN, which is comprised of the NASDAQ and the NASDAQ index options. And then the same thing for the Dow is VXD, comprised of Dow index options. Now I really put only place weight on the VIX. I really don't look at the VXN and the VXD, but it's nice to know that they exist. They do tend to resemble each other in fashion. So looking at the VIX, whenever I set a benchmark for myself, or whenever I'm using a benchmark, I like to look at the S&P over the Dow, for the reason that the S&P is comprised of 500 stocks and the Dow is only comprised of 30. So again, as I said, this is really a gauge of fear, and this is how investors essentially gauge fear, because it's pulling the data that it makes up the VIX from the puts and calls and the implied volatility related to those puts and calls that are existing, and that gives us that expectation of 30-day volatility. So the actual calculations, as in past conversations, is not as important. It's nice to know generally how some of these things are made up, and what constructs some of these quote-unquote indicators, but we'll save the math for another day. So if we take a look at the VIX on a 5-year chart and we compare that to the S&P. So this top chart, S&P 500, and these are weekly bars. And then the bottom chart here is the volatility index, the VIX. And you'll notice probably right away, the first thing that strikes out, stands out, is the inverse relationship. And the important thing about the VIX and the volatility is to understand that it is an inverse relationship to the market. So a low volatility is balanced with, in most times, a trending market, a less volatile uptrend. In thinking in terms of consistent uptrends, as we've had, for example, in the first part of this year, which the 5-year chart, the first part of 2012 is right here, and this level is roughly between 15 and 20 on the VIX, which we've seen in the first part of 2012. And if we look at what the S&P has done in the first part of 2012, well, we've just been in this steady grind higher. So low volatility is synonymous with an uptrend and a very tight range in that uptrend. Now, if you compare that going back to, for instance, 2008, when we were in this, very quote-unquote uncertain times, the fear that was struck by the participants of the markets, and we have this enormous spike in the VIX, when we've seen, volatility in the 50, 60, 70 extreme cases of volatility. That is synonymous with, again, uncertainty in the markets, fear, not only a sharp decline, but extreme changes from day to day, both in the sense of gap up and gap down, in the sense of, one day we'll have a big sell-off and the next day we'll have a strong rally. So it's important to know where we are in the VIX to kind of give us a sense of what we can expect going forward. And there's a saying that goes, when the VIX is low, look out below, meaning that, when we have a very low volatility index, just as when we have very low interest rates, well, interest rates can only go to 0. The volatility index can only go so low, and the next move would typically be higher. Interest rates eventually have to go up. They're not going to go negative, so volatility will eventually have to go up. So when the VIX is low, it's important to be cautious in the sense of remembering that the largest down days happen in the context of a bull market, typically, because you have this sense of calmness, which is then sparked the following day, in most cases, which with sure panic, because we haven't seen large moves in a long time. So, I mean, this chart is a little bit small, but you'll notice in the weekly chart we have these nice up moves, very small bars, but then followed by these periods of big body, large candles to the downside. Again, this chart's kind of small to see, but most recently, this last week, after this nice move up, and then a big sell-off to the downside. And at the same token, the largest up moves, the largest up days that occur, happen in the context of a bear market. When everyone is selling, everyone is fearful, that's when the professionals and the big traders are putting on their positions, essentially fading all of that fear, all of that panic, and that sends the market higher. And that's when we've seen those enormous Dow swings in the sense of a couple hundred points back in 2008, 2009. So a couple important things to note: the inverse relationship between the VIX and the broader markets. And then when we have a low VIX environment in the teens, that's typically synonymous with smaller trading ranges throughout the day. So we'll get into some specifics with the ES and the 6E and how you can use the VIX to curb your expectations. But it's important to note that right now, as of this evening, we're sitting right around the 22 mark. So we've been in the teens for really the first half, the first couple months up until last month. We've been sitting in the teens, and that low volatility makes for challenging intraday trading. Swing trading is a little bit easier when the volatility is super low, but I find, as we'll get into in a couple of slides, there is a sweet spot. There's a nice medium that you want to have when you're trading intraday. So when the VIX is low, look out below. It's a useful saying to kind of always keep you on your toes, and it's when you become overconfident and think that you're invincible, and you've had 5, 6, 7 trades in a row that are going in your favor. You've had a string of 10 winners in a row, and you think, well, now I'm going to triple, quadruple my position size because I just can't lose. That's when you get smacked. So when the VIX is low, look out below. Just remember to stay cautious and stay humble, and you'll stay out of trouble. Again, the inverse relationship to the market direction. And then taking a look at some of the VIX ranges and the kind of markets that they are related to. When we have a VIX that's between 10 and 20. Now 10 would be extremely low. That would be back in 05, 06, 07 period where consumer confidence is really high. We have very, very small amount of fear by a very small amount of individuals in the markets, so to speak. When we have that very low VIX, that's when we have that steady uptrend where buying dips over and over again is a very viable strategy. Back in the .com era and in the 05, 06, 07 with the real estate market and things like that, when it just seems like everything you buy would go up, that's when we have low volatility. And then average volatility as of the last 5 years or so is 20 to 30 typically, and that can either be a sideways market or a trending market, but regardless, it's reasonably balanced between the fear and the greed, if you will. You don't have these extreme price swings where you would have a Dow up 500 day and then a Dow minus 400 day. But when we start getting into 30 to 40 on the VIX, that's a little bit higher, and that's when not only do you see these sideways moves, these choppy market conditions, but that's when you get some of the larger downtrends, and more importantly, the downtrends beginning to form. So I don't look at the volatility index really on an intraday basis, in the sense that I'm not looking at a 5 or a 15-minute chart on the VIX. I just use it after hours, after the market's closed, and look at the daily chart or the weekly chart, and see where we've been, where have we come from, and where are we right now. And when we get these spikes, for instance, if we're trading in the 20 to 30 range, or maybe we've been trading right around 25, and then all of a sudden one day we get a VIX spike into the 30s, say 34. Well, you can use the VIX to confirm or act as a confluence, if you will, to a market move. So a VIX spike with a sharp move lower in the broader market can be a confirming indicator that there is some substance to that move lower. If we had a big down day in the markets, but the VIX really didn't go anywhere, it didn't really move that much higher, well, that could be a sign that, well, this down move is not sustainable. At the same time, if the VIX is dropping and the market's moving higher, that's a sign that the uptrend is building. But if the market is moving higher and the VIX is not moving lower, it's not really going anywhere, that could be a sign that the up move is not sustainable. So we like to look for those extremes and then the confirming relationship of the VIX. And really, the extremes outside 40 is when that fear and panic sets in. And that's what we saw at the end of 2008 with some of these VIX levels in the 50s and 60s, and that's when the media is all over the news, and every newspaper is claiming the end of the world in those sorts of environments. So they typically don't last very long, but it's important to realize we're on the complete opposite end of the spectrum right now, being in the low 20s in the VIX. So it's really interesting to go through an entire cycle, multiple cycles, that occur over the span of a year, a couple of years. Certainly within a 5-year period, you get all of these ranges of volatility, and to see how the trading is affected and things that you can take away from it and then apply the next time the cycle rolls around. So that sweet spot I found is when we have the VIX 25 to 35. Now that's great for day trading. Very low volatility is great for swing trading. You can buy those dips, and the stocks that are moving lower tend to continue moving lower. So those great trends tend to remain intact in the low volatility. The extremes in volatility, you can get a little bit fancy with options, or you can, higher volatility yields to higher option prices, and being a seller of premium, being on the writing side of the option can be very profitable in high volatility times. High volatility is not so good for purchasing options, being on the buying side, because the higher volatility adds to a higher price. And then if we have a big down day in the markets, or a series of down days or down weeks in the markets, volatility starts to creep up, the option prices start to creep up, and then all of a sudden we start into a nice upswing, or we have a few up days and volatility contracts. The price of those options is going to implode. So it's just kind of a side note on how options and other stocks play into the volatility, and that's one thing to pay attention to. So again, the biggest up days happen in the context of a bear market. If we look at a 6-month chart of the volatility index compared to the S&P, S&P will be on top, and then volatility, the VIX, on the bottom. It's a little bit clearer to see, a little bit more applicable pertaining to 2012 and the end of 2011, and this steady grind higher that we had really from end of November. We just moving higher, very tight ranges as well, in the sense that the pullbacks are very small. We don't have very large body candles. There's a few in the mix, a larger down day here and down here in the beginning of March, but really very tight ranges, and that is synonymous with the VIX moving lower. And we started back up here in the low 30s in November, and that's when the creep higher began, and every pullback was adjacent to then another decline in the VIX. So just as we would look at the broader market in the sense of higher highs and higher lows, we do the same thing with the VIX on the daily chart. I'm not so much concerned with the candle patterns on the VIX, but the way I do look at it is, where are the swing highs, where are the swing lows, and do they line up with, inversely, the swing highs and swing lows on the broader market, on the S&P. And if the volatility index is making a new low, at the same time the S&P is making a new high, well, that's confirmation that there's some substance there. If we made a new high on the S&P, but the volatility index didn't make a new low, I would be hesitant or suspect to that move. So it's something to certainly pay attention to, and kind of in its simplest form, just relate the price action on the volatility index to the price action on the S&P. So after creeping down on the VIX, we got as low as, I think, 14, down here in the middle of March, and the intraday ranges on the ES especially were sometimes as small as 7 or 8 points. So there's not as large of moves on the ES when we get these super low VIX environments, and as you probably noticed today as well as Friday, with the volatility creeping up and the markets moving lower, the intraday trading has actually been quite good in improving over the last couple of weeks, especially in this last week. A noticeable difference. We've gone from a period of fairly choppy market conditions in the sense that there hasn't been as much follow-through, for those trading, the halfway back methodology, where we weren't seeing, 15-minute after 15-minute, 5, 6, 7, 8 setups in a row. We would get, maybe 2 or 3, and then the trend would fail, and then we'd start trading to the downside and get 1 or 2 or 3 moves, and then the trend would fail and we go back to the upside, and we just have this period of it's range bound trading, and the moves within that are smaller. When we get up in here to the 25 to 35 volatility range, that's when we start to see 3, 4, 5, 6 setups just repeated one after another. And when you align that with a daily level on the broader term picture and begin taking 15 minutes off that level, that's when you can really get into a trade, and with trail stops and the ability to give it a little bit of room to get away from that daily level, that's when you can really catch those big runners and have the opportunity to see the much bigger profits. So delving in a little bit deeper to the ranges that we've seen on the ES and the 6E, the current range really from 2012 going forward this year on the ES has been roughly 10 to 20 points. So I just flipped the candlestick chart with trading hours only, and you can see that these smaller candles here are roughly 10 points, and then you get a large body candle in between every so often, and those were closer to 20 points. And it wasn't really until this last couple of weeks that we've seen some more bit larger body candles with some more really good trading opportunities intraday. And then if we move over to the euro, we've seen 100 to 150 pips ranges so far this year. And again, these tighter ranges, the smaller body candles when volatility is low, and then as we start to move lower, we get these larger body candles, these larger moves, and that's when you see the larger intraday ranges. And keeping in mind, 100 to 150 pips is the equivalent of 25 to 35 ES points, roughly, 37 and a half to be exact. But this number is critical. A tight, quote unquote, choppy tight day on the euro can still be a 20-point equivalent move to the ES. So it was great to go from swing trading to intraday trading. And then when I began with the ES, and then when I incorporated the euro, it was like having an entirely, it is having an entirely different market, but it's like trading two different cycles, if you will, because you have these huge ranges on the euro regardless of small volatility on the ES. So it's nice to have the ES because it's very technical, and the setups that you can get in close to the daily levels can yield very large moves, and the smaller profit potential with taking smaller profits on the ES with arbitrary profit targets, if that's the style that fits you better. It's great for setting an arbitrary profit target, like we talked about recently, just setting that 6 or 8 or 10 tick profit target on the ES. It's great for that style of trading. But then when you get into the trailing your stop, that's when the euro is, I think, even better and really exploits the trail stop. So 10 to 20 points is not bad for the ES, but when we get into a little bit higher volatility, that 25 to 35, you can see ES moves intraday of 30, 40, or even 50 points. But more importantly, more trending within the day, more setups one after another. So we'll take a look at the VIX in real time. We'll take a look at the overnight session and how that can relate to the range for the morning. We'll take a look at the first 30-minute range, and we'll take a look at the first 60-minute range and see how that relates to the outcome of the day. So that kind of ties into gauging the market speed. So some helpful indicators to do that. Coming into the day, we want to know, is it going to be a trending day or is it going to be a choppy day? And let's see, a couple questions coming in from that last slide. Kevin asks about 15-minute setups in the euro. Last week we started to see some really good setups. Today and Friday, things have really started to pick up on the euro. I'll pull up the chart in a couple minutes and show you where we are in relation to the daily, and you'll probably see that being so extended to the downside, it's you'd be hesitant to take a short down here, but when I pull up the chart, we'll go through some specific setups, and I'm pretty confident that going forward, the euro is going to be a really great market to trade, like we've had February and January, and then especially last fall. So this last month has been a little bit slower on the euro. The daily setup, we've kind of been stuck between the long and the short, and we finally just broke out of that. And I think that's had a lot to do with it. So we'll pull up the chart and we'll get to that, Kevin, in a little bit. Yeah, and Gary mentions, for him, it's, well, and for a lot of people, it can be difficult to hold the ES, hold an ES position for, 4 or 5 points with the amount of backing and filling that occurs, the amount of, little rallies and little pullbacks that happen. So the ES, it can be more profitable sometimes to set those smaller arbitrary profit targets because if you're using a small stop, and take a few more opportunities using a reduced risk method, or at least tightening your stop along the way, and getting out at that arbitrary profit target can help kind of move things along and keep the winning percentage up. It decreases your average winner slightly, but in low VIX, low volatility environments, those +8s, +10s, +6s can add up, especially over the course of a week or so. So before we get to some charts, some helpful indicators. The VIX, obviously, we've been talking about. The average true range, I don't look at it a whole lot in the terms of the indicator sense, but I do just kind of pay attention to, okay, what was the range today in the ES? But you can pull up, I think all charting platforms have a study for average true range. And that just helps, kind of give you a visual reference to, where we are, where have we been, where have we come from, and then where are we at right now. So we'll talk about the overnight session and, how far away from the prior day's close are we opening. Not so much are we going to take a gap fill trade or not, but, how volatile has the overnight session been, and how does that relate to the NYSE session? So a big gap, a large move away from the prior day's close, we're more likely to have a tight range at the open. If the overnight session is really volatile, coming into the morning, there tends to be kind of a consolidation period that happens, and vice versa. If the overnight session was very tight, there wasn't a whole lot going on, then those morning ranges can be much wider and the speed can be much faster. A great example is Monday mornings. So once in a while, more often than not, Mondays, we tend to get those large gaps. And we get a large gap, say a large gap up on Monday morning, and what happens? The market just kind of goes into a holding pattern. Maybe the first 30 minutes we drift higher a little bit, and then we just kind of drift sideways the rest of the day. There's really not a whole lot of opportunity. There might be 1 or 2 setups within that, but a large volatility overnight tends to relate to a little bit tighter range, slower speed in the NYSE session. And then, looking at the first 30-minute range, I know I've mentioned looking at the first 30-minute and the first 60-minute range on the NYSE session. So looking at from Central Time, 8:30 to 9, and then 8:30 to 9:30, and looking at how quickly from the NYSE open, looking at the first 30 minutes, how quickly do we break out of that range? And in this example here, the NYSE opened. We did have a little bit of a gap up, and we did not come down and fill the gap. Instead, 30 minutes went by, and within 15 minutes following, we broke to the upside and never looked back. And then on the same token, where does that relate to the first hour's range? So these are 15-minute bars, and 1, 2, 3, 4. After the first hour's range, so this being the low, this being the high, well, what happened? We drifted higher. We broke out right away. We made a new high after the first hour. We broke out. We pulled back to the high of that first hour's range, and then continue down higher. And if we're stuck within this first hour's range, if a couple hours goes by, we've marked the low of the day, meaning the low of the cash session, and then the high of that first hour, low of the first hour and the high of the first hour. And if we're stuck within that range, or sometimes what happens is we pierce it by a tick or two. And I should mention this is on the ES I'm talking about. If we pierce the high by a tick and then we sell off down to the low of the range, and then we pierce the low, and then usually we'll get a low tick at that point, and then we'll come back up to the high. If we're stuck within that first hour's range, well, then typically the remainder of the day that's a good sign that it's going to be a choppy day. But on the trending days, what will often happen is that first half hour. If I go back, the first half hour we break out right away, whether it's to the up or downside. In this case, uptrending, and then in the first hour, once that occurs, we continue to break out of that, pull back, and then continue in our trend. So looking at the first 30-minute range, and again, I don't trade that first 30-minute range, but it's important to relate where we're at. There's really a lot that goes on in the first 30 minutes that is very telling for the remainder of the day and the ES. So starting off the day by looking at, okay, where are the market internals opening? Where's the breadth? Where's the advanced decline line? And then 5 minutes in, okay, now where are we? Are we relatively the same to where we opened? Have we moved drastically? And then pulling up the news reports, typically either 15 minutes after the open and a half an hour after the open, there can be some sort of news. And how does how do the market internals change after that news announcement? And did we open and move higher on advancing breadth, and then did we sell off, and then did we go higher again? So were we choppy in the first half hour? And then if we mark the first half hour's range, did we just stay within that range and really not go anywhere? That can be really telling for going forward into the next half hour to give us the hour's range. So taking it 15 minutes at a time for intraday trading is really a lot of time, and there's a lot of data that you can pull from the first half hour, the first 5 minutes, and then the first hour that can help you piece together, should I continue to trade this day, or should I be cautious? And so if we begin the day and you have the 512 tick chart and the 15-minute chart up, and things are looking really clean, which using the Heikin-Ashi chart is really easy to see. Is the trend clean? Are we forming little halfway backs, breaking trend, and then forming little halfway backs in the opposite direction, or right away on the 512 tick chart, and then marking the lows and the highs of the first hour's range? Are we making a high and then a high tick, then selling off down to the low, making a low, just piercing the low, and then getting a low tick, and then rallying back up to the high and just kind of bouncing in between? Or, as the example here, did we break out and then pull back, find some support, and then continue the trend? So some things to take a look at, and we'll flip over to some charts and take a look at more examples. So just really quickly, setting those expectations. In the summer months, things tend to slow down a little bit. Volatility tends to decrease a little bit, but at the same time, recently the recent summers have been actually quite good, I've found, for trading. So it was really before 2008, the summer would be much different than the fall and spring. But as of late, the summers have been actually quite good and quite technical. So the speed can be a little bit slower, but the setups can be more technical, meaning you're taking less heat on the trades, and then they're trading right to targets and then pulling back into the next setup. So on the ES, a low VIX, it can be, you may want to look at taking smaller profit targets when we're in that very low volatility. Leaving fewer contracts as a runner, in the sense that we are not expecting a 20-point move when there's really not much out there that, in the terms of fear, or not much out there in the markets that would act as a catalyst. So Gary mentioned taking those smaller profit targets, and when the VIX is low, that can be a great little adaptation to make to your strategy. And then when the VIX is high, keeping in mind, okay, the VIX is high, the moves are larger. That's when using larger profit targets and allowing those runners, leaving more contracts on as runners, trying to catch those big moves, leaving your stop maybe a little bit wider when you're trailing, that can be a nice little adaptation to make. Sean asks, when using one contract or smaller contracts, how should the summer be handled? I think just in the same way, whether you're using one contract or 10 contracts, if the VIX is below 20, maybe look for those arbitrary profit targets. So look for a +6 or +8 or +10 on the ES, and understanding that you may have your number of trades may go up, may increase. But if we continue to rally in the VIX, if volatility continues to increase, there may be fewer entries but more opportunity to trail your stops. So in that case, if the whole summer we sit in volatility of 30, taking all the 15-minute setups and trailing the full halfway back can be a great opportunity to catch the larger move. Oh, and I'm sorry, I should clarify, yeah, Sean. When I say +6 or +8, I'm referring to ticks. So let's see, I was looking for 16 ticks. No, I just mean if volatility is below 20, you may want to look to take a profit target at 6 ticks or 10 ticks, as opposed to trailing your stop every time. It can be more profitable to take that arbitrary +10 instead of leaving your stop with this kind of false expectation that we might get a 20-point spike in the market. So obviously anything's possible, but over the long run, trying to capitalize on what do we know about volatility, what do we know about the broader state of the market, that can be a very profitable way to trade when volatility is really low. And then just quickly on the euro, taking advantage of the trail stops, there's large ranges really all the time relatively to the ES. So a small day on the euro is still a 100-pip move or 100-pip range with multiple setups in between. So I always trail my stops on the euro because, using +4 as a first target, when volatility increases, the first targets just get hit so much faster. When volatility is low, you're still only 4 pips away from either a free trade or a reduced risk trade on the euro, which is really nice. So it comes down to the euro does have better risk to reward using an 8-pip stop or even a 12-pip stop. With the ability to trail, the risk to reward is a little bit higher on the euro. But it's nice to have both because, like I said, the ES is very technical and it adheres to the setups just as well. And then, people ask, well, when volatility increases, should I widen my stop? And with stocks, I would say yes. You're adapting your stop to the range of the candle. With with this method and the way that I trade, and perhaps the way that a lot of you trade, using a smaller first target or line in the sand to tighten your stop. As I just mentioned, when the volatility increases, the first targets get hit quicker. So you may get stopped out for smaller losses more often in higher volatility markets, but it's balanced with larger winners. So it all adds out, the data set and the probabilities and the statistics all align quite nicely. So more volatility just means that those first targets get hit faster. And some chart examples. We'll take a look at the overnight range. I'll kind of try to clarify that first 30-minute range and the first 60-minute range. Gary had a question about today pulling the fibs. We'll go through and show you, exactly where we are and what I'm seeing, and what we can look at going forward. And then we'll take a look at the current daily levels. I think there's some big things that are setting up here in the ES and the Euro. We'll take a look at those. So we'll flip over to some charts. And I think typically I start on the daily time frame and go smaller. Today what I'm going to do is just leave up the chart here and go work my way backwards from the smaller time frame to the larger time frame. So both are 15-minute charts, and I'll try to go through each one and try to pull in some of these questions that are coming in. Why don't we start first? Well, on the ES, we'll start from the overnight range. So both charts have 24 hours worth of data, and then obviously the ES is, well, obviously the Euro, there's no gap fill pertaining to the Euro. So we just look at the overnight volatility in relation to the prior day's close on the ES. So we'll start there, and we'll work our way forward. So the low for this morning, the overnight, meaning the market opening yesterday, the low was down here, and then the high, I'm just going to delete these lines here. And then the high this morning, I think we was right at 3 this morning. So we had, this is kind of, I guess one of the exceptions, but nonetheless. So overnight we had fairly wide range of volatility from roughly 1290 to 1300. So 10-point range overnight, and I guess it does hold true. If we zoom in a little bit, that first half hour when the market opened right here, the gap fill down here at 1292, and a couple questions about the gap fill setup this morning. 730 would be right about here. So we were well off highs. We were kind of right in the middle at the 7 o'clock Central Time period this morning. So we had a fairly wide overnight session, and then we never made it down into the gap fill, and it's kind of strange that we would come so close and then reverse, but that's actually a very bullish sign that, okay, we came down to 93.75, and the gap fill was only a point and a half away roughly, and we couldn't fill that. So there was strong buying coming in, and after that first half hour's range, if I mark that, now the first half hour's range, notice, is still within the overnight session. So I guess in a sense that's what I'm trying to get at, in that this first half hour's range, look at how that relates to the overnight range. It's very tight. If the overnight range was 3 points, well then it'd be more common to see a larger first half hour range. So if I get rid of the overnight range, keeping in mind that that was about 10 points, and if I then mark, this is the first half hour range we broke to the upside, and then 15 minutes, half an hour, 45 minutes, an hour, once again, the first hour's range, immediately we broke to the upside. And breadth this morning was increasing. We closed actually very strong up in the 2,000 range, but this morning the breadth was increasing, so confirming that move to the upside. And then we really just drifted higher all afternoon. Little small setup at highs that moved higher into the afternoon, and then we've just been consolidating. Really, there's nothing that really ever happens kind of this time of night. I shouldn't say never happens, but nothing where is worth trading on the ES and kind of this almost Asian session, if you will. But looking at the first half hour's range, first hour's range, and overnight session, if we just pull back another day to Friday, and we mark Friday's overnight high, which we'll call it, actually, this is early morning Friday, 8:15, so right about here and here. So again, Friday, fairly volatile overnight range, about 90 to, it's about 20-point range. The first half hour was a little bit strange, but fairly tight. So the first half hour was pretty, actually the first half hour was even tighter. It was down here. So again, volatile overnight session, first half hour's range very tight, and then the first hour's range was right there. So we just pierced the high a little bit, and then sold off. We broke that first hour's range. You'll notice that whichever direction we break in the first hour, let me just make this a little cleaner, we tend to stay in that direction. So actually Friday was a little bit screwy, wasn't it? So this is actually 9:45. So this is what we want for the first hour's range. So we just pierced the high, and I don't recall if we had a high tick there on Friday. But so Friday was a little bit volatile, and we broke the high, and then we broke the low of the first hour's range. Whereas today, we broke the high and then remained above the first hour's range for the entire day, and most of the times that's what you see happen. You break the first hour's range in one direction, and you don't come back down and break it in the opposite direction. That can be a fairly difficult day to trade. So when you get a break of the first hour's range with a high tick, it's a great opportunity to take a short micro down to the low of the first hour's range. So that's something that I look for as soon as that first hour's range closes. Just going through a couple questions here. So Kevin asked, did I know the full day halfway backward trade? Well, I never know, what will happen exactly. Let's see, it was just too strong. Is there something that says it's not going to come back to the 50? If I go to the daily chart, I'll show you what I have drawn for my daily halfway back. I have the full, and I think you're referring to, I think, this draw here. So if we draw the, yeah, that would be a hindsight draw. Oh, I'm sorry. Kevin's talking about just today. So 15-minute. So I guess what you're asking is, did I know this would trade? Essentially, pulling from lows to highs is always a great pull, always a great anchor point. When you have an absolute low to pull from, it's always a great trade to take the first 15-minute setup when you have a low or a high. And this low is 1287. If you go to the daily chart, in hindsight, then you can say, okay, well, 1287 does line up down here with this daily pull, and we'll see if that holds or not. I'm not putting a whole lot of weight because, like I said, that's that's a hindsight draw. It's not me anticipating this anchor will hold. You just kind of wait and see where the market comes down to when you have these random anchor points. But what I will always draw is the absolute low back here, the highs. So this is more what I'm anticipating, the 1243 on the daily chart on the ES. And then if we actually go even larger to the monthly, and I'm just going to flip it to a candle because no, it's already on a candle. You'll notice that we have kind of this funny anchor point from the extension from highs to highs that's held once and a second time. So it is possible that we could come down all the way to 1125 before rallying. But when you have this widening formation, this kind of this wedge, I guess you call it a widening formation, where you're in an uptrend, but this high up here is much higher than this high back here, but then this low is, it's fairly close in terms to this low, this space down here. So this, we could come back down and kind of make this inverted, this backwards wedge, if you will. That can be actually a bearish sign. So drawing the ultimate, this full halfway back, seeing if we come all the way down to 1042 is certainly a much more drastic move in the longer term. But for now, we'll see. If we go back to a daily chart, we'll see if this hindsight draw here holds from lows to highs in the daily chart. And simply, okay, what will tell us that? Drawing the opposing. If we break the 61.8, then we can draw the next setup from lows to highs. Now this is the daily chart, so this would be over a period of weeks that would happen. But given that, we're kind of bouncing around a little bit, but given that the S&P, if you look at this volume on the daily, the only time that I do look at volume on the ETFs here, increasing volume as we move lower on these big, large body candles. And look at today's volume, relatively very low. Now we did break yesterday's high, we did break Friday's high, but that volume to the downside was pretty heavy, it was pretty bearish. And then if we flip over to the VIX, what's the VIX doing? Well, the VIX is moving higher as well. Again, today we did break Friday's low, but we'll see if the VIX can make a new high, if the VIX can go above 25, and the S&P will look for a break of Friday's low to confirm more movement to the downside. So kind of tying all this in together, if we get another move to the downside, I'm not holding too much weight on this most recent daily, but the full down here at 1243, I would, not only is that the full halfway back, but we do have this cluster of support down here that we could end up, bouncing around at, seeing VIX go up to 30, 35, have some really great trading opportunities intraday, and then, begin to drift higher, or else, much larger, and I mean much, much larger sell-off to the downside. So, while I don't I don't usually try to predict that far out, this would be my near-term line in the sand. This 1243 would be kind of that magnet that I'd be looking for the market to trade down into, because we already broke the extension up here. Let's see, highs. That's what I want, highs to highs. So we broke the extension, so it only makes sense to draw all the way halfway back. And you can always pull, from any of these anchors and pull random longs from any of these anchors, but it just makes it so much easier to go all the way halfway back and look for a move off of that level. It also helps keep things in perspective a little bit better, just focusing on, okay, all the way halfway back. I'm not trying to, pick a little long here and then find another anchor here, and then we get a little bounce, a little bounce, a little bounce. I just go right to all the way halfway back. And let's see, I know I missed a couple questions in here. Yeah, Mike, yep, got that. Tony, let's see, Gary. Okay, good. Sean mentioned the gap fill this morning. Yeah, I can quickly go through that. And yeah, like I mentioned earlier, we didn't get all the way down to the gap fill. I guess, let's see here. If we go to the tick chart and just flip it back over to the Heikin-Ashi. So the 7 o'clock time frame. So when I wake up in the morning, especially on a Monday, if we're already well off highs, so the gap fill is down, I don't know exactly, down about here. And let me get the exact number of the gap fill. Yeah, 1292.50. So we're on the tick chart, and the gap fill is 92.50. So if I wake up and if I look at the markets at 7 o'clock, and we've already kind of broken the setup up here. We pierced the 61.8, and now we're down here. The entry, dirty as it is. Let me zoom in a little bit more. Breaking the 61.8 and then kind of piercing the negative 23. The next setup down here, right about 7. Yeah, it was about 7:30 at 98.50. But if you didn't take that, certainly no worries. Again, it's not the cleanest gap fill. And obviously we didn't even end up filling. So small trade opportunity to at least get your first target hit, tighten your stop. The next setup again was dirty, but when we're already well off highs, so I'm looking for a short at this point down to 92.50s. Well, at 7 o'clock we were already halfway there. Then a gap fill is not as appealing, especially on the Monday morning. So not much going on in today's gap fill. Again, Mondays can be a little funky, either a big gap up, or today we got close to the gap fill, didn't fill it. But if you took it, you still get a first target hit and then some. If you trailed the full, still an opportunity to get a free trade, lock in a small profit, and then go about the day, drawing that first setup from lows to highs, and then taking smaller trade, either smaller trades, zooming in on the 512 tick off that level, taking 15 minutes off the larger 15 minutes, so to speak. And then just looking at the euro, I'm going to flip to the daily chart first because the daily is getting really interesting. We were in this short on the daily, and we broke the negative 23, traded down to the negative 61. So I drew from lows to lows, and we traded up into the extension short. So if I go to the 15-minute chart, now the long technically traded first, so there was a really nice setup this morning, about 8:15, 8:15. Really nice long setup. Then there were a couple micros. There were like 4 opportunities to get into the trade. It was a really, and that's the environment that you have in really great euro, a really great euro market. There's multiple opportunities to get in at these big levels. So we came up close to the extension, but we didn't quite trade it. The long traded first. We had some shorts down into that long setup, and then there really wasn't a larger 15-minute setup after this yet. You notice we didn't pull back into the next 15-minute setup. Overnight, I will be watching for this extension to hold and break the 61, or for us to drift higher, trade at the negative 23% target, and then the next 15-minute setup to trade. So this being a big daily extension short, and the fact that we are just off lows, and we had this big, this was months, about 4 months trading sideways in this range between this long and then the short. This is, there's a lot of weight on this extension short. If we break that short and the long holds, we could draw the next large halfway back, which lines up with lows, and look at that level for next potential larger short, because we are still within the large weekly short above us. So again, the euro, these are extremely large time frames. There's longs and shorts within this big weekly, even monthly level. But it's important to know that we are coming off lows. So this setup, essentially, counter trend up into the extension, because it traded first, was certainly valid. We had a little micro this morning, and then there was a little micro. Let's see. So if you waited, wait for the first micro to trade, because this is a big level. We had a little micro down here, and then we had the second micro in the trend, and then even the full micro, also traded. So that was the 15, the first micro, the second micro, a little bit larger micro. So 4 opportunities to get in, and then whichever setup that got you into the trade, you can either trail the full, keeping your stop wider under the 61.8, meaning keeping your stop under the 61.8 of the full, or you can trail each micro setup, trailing all the way up. And there really wasn't an opportunity to trade. There really wasn't a need to trade 512 tick charts, because we never ripped higher. So that wasn't really applicable for this setup. Let's see. Gary asks, is that a big rule for me to trade the first micro off of 50? Yeah, absolutely. First micro. So what he's asking is trading the first micro off a big 15-minute level? Absolutely. A level like this on the euro, when we haven't been in a series of 15 minutes, meaning this was the first 15-minute, so, saying, okay, big 15-minute level, let's see if it trades. Let's see if there's something there. Okay, there is something there. Now, let's zoom to the tick chart and take the first micro after the trend changes. So if I get really tight in here, again, this is the 50% 15-minute. This is the last little swing high, waiting for that swing high to break. And there were multiple entries, but let's say we're going to wait for 2 pips above this swing high to break, and then we're going to take the first micro in the trend, in this new trend. So we're going to say, okay, well, this one wasn't quite 2 pips, so we're going to wait. And okay, this was definitely a 2-pip break. We didn't quite get all the way halfway back. Boom. Drawing from lows to highs. We broke the swing high. We traded at a 15-minute 50%, nice and clean. And we took the first micro after that 50%. We put our entry 1 pip or 2 pips in front of the micro 50%, and then boom, just trail halfway backs or trail the full all the way up. Yeah, so this little swing break I talk about, I think in the Identifying Trends webinar, is pretty crucial. Waiting for that little swing high and swing low to break. Yep, for confirmation. Exactly. So 2 ticks is kind of what I use for my failure point, meaning I like to see a pierce of the 61.8 by 2 pips for failure. And that's just kind of just an arbitrary number I use. So 2 pips of the swing break or 2 pips of the 61 to confirm the failure point. So that kind of touches on the ES. We touched on a little bit of the overnight session and how that relates to the first 30 minutes, looking at, where do we go from the first hour's range, first half hour's range of the NYSE session. Now that stuff's not as applicable to the euro, but the setups are, it's almost nice having less information to pull from, because it keeps things a little bit simpler. And we talked about the daily levels, the overnight, first 30 minutes, and how the volatility relates to kind of adapting your methods to the intraday swing trading. So I hope that was helpful. I think I touched on everyone's questions here. Again, thanks for asking your questions. It really helps, kind of helps you get the most out of it, and helps me see what kind of areas need more clarification. Kevin asked, do I still use tape reading? No, I took off my time and sales chart that I used to have here on the right. I found that it was nice to have, but I really wasn't using it to execute trades. I really wasn't using it for any sort of actual trade confirmation or execution. So it just added clutter to my screen. So that was part of my condensing, simplifying on my screen. That was one of the things that went. So some of that stuff takes a little bit getting used to, but what I found is that if you're going to make a change to your trading screen, I do it on a Friday. I do my analysis, I shut down, and then Monday morning I open up the charts, and I've had the weekend to kind of rest my eyes, and then now I have a fresh trading screen, and it makes it a little bit easier to adapt, because you probably notice in your own trading screen your eyes just kind of gravitate towards certain corners of the screen, certain parts of the screen, and then it adds to that kind of level of trader intuition, subconscious things that you pick out that on a deeper level is kind of just a visual thing that you adapt over time. And no, I don't use 233. I just use the 512. The euro's been moving enough where there's enough data on the 512, and it kind of filters out some of the noise. Yeah, both on the ES and the euro. I just 15-minute 512 daily. Boom. That's like I said, keeping things as simple as possible, and it's amazing after all the years, still being able to simplify. And I think this is about as simple as I can get it, but we'll see. Over the next couple of years, I may end up removing a couple other things if it comes down to it. So thanks everyone for checking out tonight's webinar. If you have ideas for future webinars, feel free to shoot me an email. I'm happy to entertain all ideas. So thanks again, and we'll talk to you next week.